What if I told you there's a stock that's already up over 330% in just 1 year, and yet, based on its forward valuation, it still doesn't look expensive? Sounds crazy, right? But here's where things get interesting. This company might be printing profits faster than most investors realize. Let's talk about Micron Technology, a major player in the semiconductor industry. In simple terms, Micron produces memory and storage solutions that power everything from data centers to consumer devices. So basically, if data is the new oil, Micron is one of the companies helping store and move it. Now, why is this stock suddenly everywhere? First, the latest earnings came out on March 18, 2026, and investors are closely watching how the company is performing after this massive rally. And second, the stock has already surged plus 336.76% in the past 52 weeks. So the big question is this growth justified, or are we looking at a potential slowdown? Let's break down the numbers. In the last 12 months, Micron generated $58.12 billion in revenue and an impressive $24.11 billion in net profit. That's not just growth. That's serious profitability. Even more interesting, the company is running at a profit margin of 41.49% and an operating margin of 48.41%. So what does this mean for investors? It means Micron isn't just growing, it's doing so very efficiently. And here's where things get even more interesting. The company produced $30.65 billion in operating cash flow and $10.28 billion in free cash flow. That's real cash, not just accounting profits. Now let's talk about financial strength. Micron is sitting on $14.59 billion in cash with only $10.80 billion in debt. That means the company actually has a net cash position of $5.83 billion. And with a debt-to-equity ratio of just 0.15, this is a very conservatively managed balance sheet. So in simple terms, Micron is not heavily dependent on debt to grow. Now, here's something long-term investors love. Micron's return on equity is 39.82%, and return on invested capital is 37.40%. These are very strong numbers. What does that tell us? The company is extremely effective at turning capital into profits. Now let's talk valuation, because this is where things get really surprising. The current P/E ratio is 20.90, which seems reasonable, but the forward P/E drops all the way to 4.96. Yes, you heard that right, and the P/E ratio is just 0.05, which suggests growth may be significantly undervalued. So the big question is the market underestimating future earnings or expecting a cycle peak? Of course, it's not all perfect. The stock has a beta of 1.54, which means it's more volatile than the overall market. So expect bigger swings, both up and down. Also, after such a massive run-up, expectations are now very high. Even a small disappointment in future earnings could impact the stock price. Looking at analyst sentiment, the average price target is $443.47, which is almost flat compared to the current price. And while the consensus rating is strong buy, the limited upside suggests that a lot of optimism may already be priced in. For income investors, Micron does pay a dividend, but it's very small, just 60 cents per year, with a yield of 0.13%. So this is clearly more of a growth story than an income play. Is this just the beginning of another growth phase, or are we closer to the peak of the cycle? That's something only time and future earnings will reveal. If you found this breakdown helpful, make sure to subscribe for more deep dive stock analysis. And as always, do your own research before making any investment decisions.